Well, I think to some extent the move has not been entirely priced in because the Fed has also not made it explicitly clear what they're going to do. I mean, to be clear, the end of QE was seen coming from some distance in any case. So that was pretty much a consensus. So what the Fed did go out of their way to do was to state that that the dependency on data swings both ways. So they say if data are better than expected, then the rate hike would come in sooner, or if vice versa, it would be later. So they've made this a more symmetric risk. But even then, I think clarity on exactly when that's going to take place, and more importantly, the pace of rate hikes that follow. I think these are the uncertainties that remain, but markets are not rushing into it because for now, I think the perception is that it's not going to be any sooner than middle of 2015. Well, I think this is something that we saw coming. Given that this past FOMC in October did not have a press conference that followed, I think there was no major impetus to remove that considerable time because that would leave the Fed without enough runway to explain any misgivings or any misinterpretation. So we think that any change to that particular statement will come through in December when there's a press conference, or perhaps after that. But what the Fed did do to mitigate that risk of that considerable time is that they tackled it from the labor market side. Instead of saying there's still significant underutilization, they say that the underutilization is diminishing. So they are priming markets to change that considerable time reference. Inevitably, I think the initial Fed interest rate hikes, what it tends to do is it causes the marginal yield-seeking investments in emerging markets to capitulate. So initially, we could see some sell-off in a lot of the emerging markets, and that has been proven quite a few times in tandem with Fed yields. And I think another point that I think we need to get across is that yields have actually softened since they hit 3% late last year. So which means that when the initial rate hikes come in and interest rates go up, there is another opportunity for a sell-off because the yields have softened rather than being priced in incrementally.